Once again, we wanted to thank everybody for being here for session 12 of the Delaware Economic Summit. Today's topic is going to be the 10 biggest tax mistakes of 2013. Today we have speaking from the Santora CPA Group, Myunghee Geerts, who is going to go to this presentation. We thank you very much for being here, and thank you very much.
Thank you. Good afternoon, everyone. Oops. It's a new hotel, so I cannot screw up yet, right? Okay. I'm tax manager at Santora CPA Group, and my topic today is, as John just introduced, it's the 10 biggest tax mistakes of 2013. When it comes down to tax, I think about two aspects. One being, does this return has any exposure? Meaning that, does it has any risk involved? Or the second part being, are you paying the absolute minimum tax on your return? Those are the two aspects, and I tried to come up with the idea which I'll be discussing. And my presentation today has three goals here. Compliance matter, I talked about exposure, right? So does your return have any exposure or any risk involved if the IRS or any of the state government challenges your position? That's what I'm going to talk about as the first part. And then second part and the third part, where we can discuss about additional exposure related to real estate rental, and then also the commonly missed tax incentives. Before I even start mine, I want to say one thing though. We all have different situation, right? Some of you have a W-2 job only. Some of you don't even have a 1099, the portfolio or investment income or activities. And some of you, only thing you do is you have a business or trade or business, and then you get the K1 and that's it. How can you ever come up with 10 topics that belongs to everybody's situation? Impossible, right? So hopefully I have 10 topics here, but one or two really hits your situation so that you feel like you got something out of it. And also before I start, I have a presentation folder here, which is basically copy of my presentation, but if you don't feel like you got anything out of it, at the end of the second part of the packet has some of the tax saving ideas. Hopefully that'll help your situation as well. Okay, with that, if you see this warning sign, that means we have to be aware, like any exposure and any risk involved in this concept. But if you have this opportunity sign, that means maybe you can save some dollars. So let's start with the first part here. Do you ever send your employee, agent, or contractor to another state? Any of you? None of you are business owner, I guess, right? But let's just know what's going on here. So if you do, it's time to think about some of the exposure here or risk here. Let's assume for a moment that we all have a business in Delaware, and then you start to expand your business. So your employees or contractors, agents goes to other states, they travel. What happens? Something we have to worry about. Also, let's assume that I have my name is Myunghee Geerts, and then MG Inc. I have a company, and what I said is a product, tangible personal property, meaning that whatever you can touch and move, that's a tangible personal property for tax purposes. And rather than my customer from Pennsylvania, let's say, come to Delaware to my store and then buy it where there's no sales tax, right? Or do I ship it to them? Does it make our tax situation different? Or another situation on top of that, what if I deliver, rather than using shipping it out by common carrier like FedEx, UPS, USPS, what if my own truck with my company logo drives to Pennsylvania and drop off the product? What is the tax implication here? We have three different situations here. So if my customer come and picks up, there's no sales tax, right? If I ship my product by common carrier, technically speaking, when the FedEx truck comes to my store, pick up the product, that's the moment the title passes. In other words, that is a Delaware sale. Nothing to worry about. You can sleep at night. But what if I drive with my truck and drop it off in Pennsylvania? What do you think? Title, my chair, let's say that my product chair in my truck is my product, or I have ownership of that chair until I drop it off at the Pennsylvania, the restaurant, the place of my customer, right? There where we have to start to be concerned about state nexus issue. The meaning of the nexus is a presence, business presence. You are there. Even though you are not the vendor registered in Pennsylvania, you are there. So I just introduced the concept of nexus, but there are a couple of different ways to create a state nexus. And then one of the good examples, the selling the product, right? Shipping and delivering the product. Or, for example, I say, well, Delaware, everything is so expensive, so I rent a small storage in Pennsylvania. And then I store all of my inventory there. What happens? Well, I'm sorry, we unfortunately create a physical presence in Pennsylvania because my product under my name is sitting in Pennsylvania. It's the same as you have another office in Pennsylvania, even though none of the transaction is happening in Pennsylvania in that storage. And also, let's convert my company MG Inc. as a service provider, repair shop. If my customer brings the product to my store in Delaware, I repair it and they pick it up. There's no sales tax matter. However, if I go to Pennsylvania, repair there and come back home, and there is a good revenue out of that transaction, you got some money out of it. You have some sales going on there. Then that may be taxable. So the nexus concept is not new concept, but with all the economy, we all struggle, right? So did the state agencies or state governments. So they have decided to come up with this route to catch up their lost revenue out of the other taxes. It's really fast-moving environment in this area. And states are we do see, research engines for our tax purposes. We have quite a few engines. And you hear from them very actively. It's not, we have a 50 states. And a little bit later, I'm going to talk about what type of tax nexus we have for state purposes, but 50 states are there or active. So something really you have to watch out if you have a business here. So with that, let's assume that you have a nexus, right? Then if you don't have a nexus, for example, everything I do is I have a product in Delaware and everything is shipped out of the common carrier, no state issues, nothing whatsoever. But once the things that I have discussed with you get involved in the transaction, there is a time that you have to be concerned about nexus. And let's assume that you believe that you have a nexus. What should you do? Three questions to yourself. 1, do I have a nexus? We believe we do. At least I'm concerned, let's say. Then, is that say, a taxable transaction to you? To that state, meaning all those states come up with the exemption list, meaning that, okay, even though it's a taxable sales, because of the fact that customers are certain tax-exempt organization, or because of the fact that certain products that are considered non-taxable in that state, you don't have to worry about tax consequences. For example, Pennsylvania, they have a manufacturing exemption. Basically, whatever you buy, it will be taxable to general public, while if you use it for that manufacturing purposes, it's not taxable. So there is a whole, administrative kind of procedure to take to get that exemption, but it's available. So it's not only knowing that my transactions are taxable, but at the same time, we have to determine if those are taxable transactions or not. Okay, let's assume yes to both the first two questions. What do we do? Does that mean that I have to be registered? And actually, one more thing. I mentioned to you, the one example I use is the sales tax, right? But unfortunately, there are two more type of taxes: income tax, also payroll taxes. A while ago, we had a weather disaster in Delaware, and one of the example that I can use, actually the director of the Delaware uses is, let's assume, any of the telecommunication company, Comcast for the moment, and they send a lot of employees who are mainly working in New Jersey to Delaware to have the disaster recovery, right? So they come here in Delaware and they stay in the hotel for 3 weeks and then, help the Delaware to re-establish Delaware and they go back. They file their expense report, right? They have mileages and they have a hotel bill. And they submit it. New Jersey comes out to Comcast New Jersey office to audit. And then they found all these activities in Delaware. They share it with Delaware, and Delaware look at it, oh, I am 1 day stay for payroll tax purposes. What does that mean? If you have a 1 day business working day in Delaware, you may be subject to payroll taxes. So they start to send a notice to all the individuals that submitted the expense report saying that, excuse me, Mr. Disaster Recovery, I need your return. The one good thing though, now it was the example I gave you was a couple of years ago example, and now Delaware came up with the idea that if it is the shifting of the location of the workplace resulted from the disaster recovery, they're exempt. So they don't have to do anything. Hooray, right? And also, there are some reciprocity among the states. For example, I live in Pennsylvania, and let's say that my company, Santora CPA Group, asked me to go work in New Jersey. New Jersey and Pennsylvania has reciprocity so that even if let's say that I get to work on the project in New Jersey for like an entire year, I don't have to worry about anything because they have reciprocity. A lot of concepts that I'm introducing you guys, but one thing for sure, we have to watch this out. Things are moving very fast, and couple of times that I spoke with controllers or a CFO function, and I asked them, what makes you be awake? What keeps you awake at night? Part of it tells me that's the nexus issue. It's moving really, really fast, and whoever signs the return is responsible if something goes wrong in that company. So, watch out. And here, quickly, so you have an access to taxable transaction, and if you're required to register, what that means is that basically you are registering as a foreign vendor doing business in the state. So it is considered as you are being in-state vendor. So that means that they have all of your record, and you are considered as a businessman in that state. So that means you have to file the tax return, and you have to collect the taxes. For example, sales taxes, you have to collect it and remit it to the state. But one more thing here. The last thing you want to do is, I think we're going to all agree here, last thing we're going to do is register with any other foreign state. A lot of money, administrative burden, and whenever you submit the return, that means that you leave the record. So there are audit issues, a lot of things get involved. So before you make any decision on whether you're going to register in that state or not, I would really do the serious review and make sure that until you're really super required to register, I will register. Seriously. Do you guys have any question on this? So that will bring us to the second topic, which is another compliance matter. If you have a business, having an employee costs a lot of money. So especially in the early stage of a business, they usually happen to hire an independent contractor, right? Do you believe your work classification is correct? This is not the new concept. It has been with us like forever. But over the years, IRS came up with 20 different determination factors that they uses in determining whether a worker is an employee or a contractor. And then the ones that are common and being used on all the tax court cases are right here. And basically, to the eyes of the IRS, everybody's employed until you prove otherwise. So based on this, today's presentation, all the 10 topics that I discuss here, there are a lot of facets into it, a lot of different factors that will, change the direction of the tax consequences or tax position. But I'm just introducing the concept of it, so I'm not going to go every single line of it. But based on those, you believe that, ouch, I might have to treat my worker as an employee. What does that mean? Does that mean that I'm going to get audited and hit by like a huge penalty and interest and ouch, right? Any remedy for that? There is one available. It is called Voluntary Classification Settlement Program. And to be able to participate in that program, you have to meet 3 requirements. 1, have you issued all those 1099s on a timely manner? Whenever there is an issue with a independent contractor or employee, then issuing the 1099 on a timely manner, this is a darn. I've never seen any program getting exclude this one. So Nancy, you have a independent contractor, make sure that you issue the 1099 miscellaneous on a timely manner, because that is the golden key. I mean, if you're not in compliance with 1099 requirement, you're kind of done for any of the remedy program. And also, if you treated that person as an independent contractor, non-employee, consistently for all those years, and also you are not under the IRS audit with any of the payroll-related issue, and you are not under audit with any of the worker classification issue with any Department of Labor or state agencies. If you meet all 3, the program available is you just file the form 8952. What does that to you? Let's see. Sounds quite attractive though. If you do file 8952, basically you are agreeing. Going forward, from now on, I'm treating my worker who I've been treating as an independent contractor as an employee. So because of the fact that you come up front and you voluntarily disclose that I mistreated my worker, you get additional perk here, which is really good. Only 10% of their last year's payroll employment tax liability you get to pay. No interest, no penalty. It's a darn great deal for all of us. So maybe if you believe that you kind of fit into this category, it's a time to revisit it and make sure that you straighten everything out. And also another good thing is that they are filing and proving, running through this disclosure program. They're not going to question anything about your prior years. What a deal. It's rare to find this kind of thing in the world of tax. I can tell you that. Okay, so with the misclassification, we have this remedy program. What if you believe, okay, based on all those reviews, I believe I'm treating my worker as an independent contractor correctly. Let's talk about how we can make our debt tax position stronger. Again, file 1099 means on a timely manner, and also documentation, written contract before you even assign the job, and all the bids and licensing requirements, W-9, whatever is related to that person, especially the both parties intend that you will be an independent contractor so that you are responsible for your own tax consequences related to this agreement. And I am not going to treat you as an employee for payroll tax purposes. Documenting all this will make your case stronger. Remember I said that to the eyes of the IRS, everybody's an employee, unless you prove otherwise. And if they ever challenge you, you're gonna have to prove, and these will be the things that make your case stronger. Any questions on this? How are we? Okay. First topic, I spent relatively a lot more time than other topics because these are the areas that really I feel like our clients or generally we don't know what's going on here. So I wanted to kind of give you a heads up on what's coming on our way, all of us. With that, I'm gonna move to third topic. The world is getting smaller. Technology brought a lot of the things, but at the same time, a little bit negative kind of consequences here. Living in US, we have bank account in Europe, piggy bank, real estate, name it. You have your assets all over the world. Then you may have to check if you are subject to the foreign bonding requirements. Here, again, I'm not going to go over the detail, but the reason that I bring it up is the penalty is it's just outrageous. $10,000 per instance. $10,000. And one example I'll give you here. Let's say that I had $100,000 in euro in one of the European banks, right? During the year, I decided to move the bank. So from bank A, I moved to bank B. Same amount, $100,000, right? How many, if you don't do any filing, how many instances do we have here? 2. Because if you see the chart here, during the year, at the end of the last day of the year, your balance is over $50,000, right? That's what it says. However, at the same time, or if your balance is over $75,000 anytime during the year, so for the bank A, I had a $75,000, right, before I moved. And bank B, I have another $100,000, and I have again $100,000. So we have 2 instances here. If they ever decide the issue, you can get up to 20 grand. Ouch. Here I have a type of foreign assets that may be subject to the foreign financial reporting requirement. And example, the one question that I hear all the time is that, okay, I have an account in the Charles Schwab and they invest in the mutual fund, foreign mutual fund. Am I subject to this rule? The answer to that question is that just think about it. Isn't that reported to under your 1099? You just receive for your return, right? Then you don't have to disclose it, right? They all know. IRS knows what's going on with your investment in the US, even though it's a foreign asset, the mutual fund that or stocks that you invested on through the mutual fund. So that's not subject to this rule. But if you use the foreign banks or other matters that listed here, you may be subject. Okay, I think with that, my first part is done. And do you guys have any questions? Let's talk about this. Oh, yes?
I have a question going back to the Nexus. We have a virtual company, everyone works from their homes, and we have employees in different states, even in different countries.
Right.
With employees in different states working from their home, does that give us a nexus in that state? Is that a taxable action where we have to be concerned with payroll?
Okay. First question I want to ask you is that in your office do you have a business in Delaware? Do you have a seat for all of these people?
Do what?
Do you have any spot, like a desk and chairs for, no.
No.
The one thing about the Nexus is that if they are working from their home for the convenience of the employer, and there's other matters, requirements also, but that is the main thing, and you agree that they're gonna work from their home, that means that that's their tax home. Therefore, that becomes their taxing jurisdiction. So your case, probably you have to review your payroll tax matter.
But it would be something that we would look into if we do have a nexus in that.
Right. And actually, do you remember that also I mentioned the presence of your employee, agent, and independent contractor, right? What that means is that you don't have anything to do with that state. But because of the fact that one employee sitting in her home, working from home, you have created your second office for tax purposes. So even though for the other matters you may not have any nexus, for payroll tax purposes and potentially income and sales tax as well, because it is viewed to the state as you have your office in that state. Then again, you have to go through all those questions and determine what's going to be taxable and not. But technically speaking, you are considered that you have a business. And for example, one of my clients, Sherry, you know what I'm going to talk about. They have employees in Maryland and Massachusetts, right, and Pennsylvania. And basically, they're outsourcing their employees. So their office is in Delaware, and then their employees go to their my client Sherry's company's customer in Pennsylvania and Massachusetts, right? Of course, they get paid for that. They have a gross receipt. But the thing is, because of the fact that they have employees there, they will create an income tax nexus. But whatever you get out of whatever you pay, your customer pays to you, becomes taxable, and it by itself creates a nexus because of the fact that employee living in Massachusetts and Pennsylvania and working on behalf of the company, it's an agent rule. So that you have created income tax, and that means that you have to determine what's taxable in that state for sales tax purposes, and probably payroll they already do, but you have to withhold under that state because they are working there for 365 days a year. So it is really time to discuss with your accountant and make sure that everything is good to go. Thanks for asking that question. There's a really good question. Okay, second part. Real estate rental. Why do I even care about this one? And I didn't know anything about you guys' tax situation, whether you have a rental property or not. But the reason that I bring it up here is that a lot of mistakes around this concept. And back in the day, good time, just like old folks say, good times. What happened was that, the economy is good and there are a lot of tax kind of shelter opportunities. So what happened back in the year before 1986 was that you buy the property, throw it on the LLC, create a maximum loss to the possible, and then bring it onto your return. What happens? Whatever the taxable income that you have on the page 1 of the return above the AGI, you just reduce it by the amount of the loss you created from the rental activities. What happens? So a lot of people, like practitioners and academics, this is a great tax shelter opportunity, right? We all read it and we all did it. But unfortunately, IRS agents read the article too, right? And government, people working at the government also read the article too. So they came up with this Section 4, Internal Revenue Code 469, called passive loss limitation rule. And the second part, I'm going to heavily talk about that one. Do you have a vacation home? Any of you? Okay. Depending on your personal usage, your vacation home can be taxed in a different way. If your personal use, so basically you and your family member, whoever doesn't pay rent at the fair market value, it's over 14 days and your rental is less than 14 days, then you don't have to report any of those income. It's tax-free. At the same time, because you don't tax it, you don't get any deduction related to rental expense. Makes sense, right? That's only so fair. And all those real estate interest and then the taxes you can deduct from your Schedule A. Second scenario, what if your personal use is below no more than 14 days or 10% of your rental? What happens? Technically, you have 2 activities, but still your personal usage is a minimum that you get to report all the rental activities under Schedule E. Your personal, you only get the tax deduction on there under Schedule A. and like interest expense or any of the rental related expense, you don't get to deduct from your return. On the flip side, what if your personal use is dominant, meaning that more than 14 days or 10% of the total rented days? Then technically speaking, you can split the deductions or income this way. Schedule E, but just be aware that the personal here, the rental, other expenses, whatever is indirect, meaning that you get the benefit of that expense. For example, maintenance or utilities. You stay there and you use it also, right? But only for the portion that allocable to the rental activity, you only get to deduct if you have an income from the rental activity. The next topic is rental loss. So I discussed with you about 1986 world collapse, right? For all those people with a lot of investment in rental activity. What the Section 469 did was brought the concept of the passive activity. Under the code, passive activity is defined as a rental activity, right? You have a real estate rental and you rent it. Or any of the trade business that you don't materially participate. What does that mean? Material participation, we call. What it means is that I have a business activity and I get involved on a regular, ongoing, and substantial base and continuous base, then it is considered material participation. And there are several rules to determine whether I am involved in that activity, materially participating or not. But simply speaking, technically speaking, if you go there to work every day, you say material participation. On the other hand, if it is a rental, you cannot consider it as a material participation. Rental by itself is by default considered as a passive activity. So recap here again. Material participation in the trade or business is a non-passive, while passive activity includes a rental and any of the trade or business activity that you do not materially participate. Under the code, after 1986, if you have a passive activity loss, you can only deduct up to the passive income you have from other activities. So on your return, let's say that you have two rentals. One creates the loss and one creates the income. You can net against each other. So whatever is the net is that year's net passive loss or income, right? Outside of this general rule, this is the general rule regarding the passive loss deduction. Any opportunities around there? For example, there are three kinds. I mentioned to you that if you have a passive loss, unless you have a passive income, you cannot deduct that losses, right? We all agree? Okay. What if I never had any other passive income? What happens? I mentioned to you already that it's not going to get deducted unless you have a passive income, other income. So what happens to that is that it gets deducted. It gets suspended and carried over to the year after year after year forever until you have other passive income. But the three opportunities that you can take that deduction is that if you dispose the entity, the rental property, you sell it, then whatever is sitting in the bucket as a suspended losses, you get to deduct it, meaning that you can deduct that you can reduce your non-passive income such as W-2 wages even. Their characteristic of the passive loss changes to the non-passive. Therefore, you can reduce the pure taxable income, the earned income kind of nature. Other two examples, let's say you own a rental property, you gotta at least own 10% or more for this $25,000 allowance purposes, and you are heavily involved in the activity. Meaning that you sign the contract, and also you maintain the property, and also when there is a repair needs to be done, you call the person and tell that person exactly what should be done, what should be fixed. That is called, in terms of tax language, we call active participation. I know I'm introducing a lot of different jargons here, but So this active participation is different from material participation we talked earlier. Material participation happens when you're involved in the trade or business, but rental, we discussed that it's going to be, by definition, passive, right? But what the opportunity we have here is that if your modified AGI is below $100,000, you can get to deduct up to $25,000 loss from the rental activity, which is normally treated as a passive loss. Unless you have a passive income, you couldn't deduct it, right? But if your AGI is $100,000 or lower, you can. Let's use an example here. Let's say that your AGI W2 wage is $100,000 and you got $28,000 rental loss. That's it. You have nothing else but those two items. What happens? Because of the fact that, let's go ahead. Let's reduce the AGI a little bit here, 90 grand. And then you have 28 grand rental losses. Technically speaking, because of the fact that your AGI is below 100,000, and also because of the fact that you own more than 100% of that property, you can take a full $25,000 deduction. So your taxable income for that year becomes how much? 90 minus 25. Anybody, any help? Okay, 65, right? And also, what happens with the 3 grand that you couldn't deduct? Then general rule kicks in, because this is an exception, right? General rule kicks in, and whatever 3,000 that couldn't get deducted gets suspended and carried over to the next year. And again, the general rule applies. Are we good so far? Another opportunity here. In earlier section, mentioned about 3.8 net investment income tax, right? That's a steep one. But this real estate professional election could help that case as well. So there is a concept election. You can make an election on your return to be treated as a real estate professional. Who is a real estate professional for tax purposes? Not like a real estate agent that you work with when you sell your property. As long as you meet these two goals, 50% of your personal service time devoted in the real estate business, and there's a definition at the bottom of the page. And also, you have to spend more than 750 hours in that same nature of the business, then you can technically elect to be treated as a real estate professional. What does that mean for tax purposes? That means whatever loss you have from this business, you can reduce your earned income or non-passive income. So my previous example, we had a 90 grand, right? 28 grand, entire thing. If this person is treated as a real estate professional for tax purposes, then we can take entire 28 grand. Reduces your taxable income, and not only that, because of the fact that this real estate professional is treated as a non-passive function in that activity. Do you remember that rental is generally passive, but for this particular exception, you are treated as a non-passive activity even though you are involved in rental. Therefore, it can reduce your taxable, not only taxable income, but also it can you can avoid the 3.8 additional tax. Are we good so far? Any questions? This is a great opportunity in my opinion. Next. Okay, I see a lot of this kind of situation, but I have a rental property, and we talked about definition of the trade or business, right? Non-passive activity, meaning that ongoing, continuous, substantial basis. I work in that business. I work in that business, and why not? I want to rent a building from myself. Because of the fact that you rent it from yourself, it is considered as a self-rental by definition. How is self-rental taxed? Unfortunately, if the rental creates a net rental income, that gets recharacterized as a non-passive, just like a wages, for example. What does that mean? We are falling into the trap here. Because I wanted to have a rental property so that all the passive income that I wanted to reduce by using my rental losses, I cannot do anymore. It's a two separate bucket, non-passive and passive. That's the first trap. However, if you have a net rental losses, that means you can technically cannot consider as a non-passive. So it follows a general rule, simply speaking, meaning passive losses. But I heard about this great rental, self-rental rule could might benefit me because, well, it's a non-passive income, so I thought it's gonna be treated as a non-passive losses if I have net losses. Not so. So we get to fall in another trap that, we're hoping that they get treated as a non-passive losses so that you can reduce your taxable income from the earned income. It's not gonna happen. This concept, I see a lot of cases we miss this concept. So if you have an accountant prepare your return, make sure to ask this question. If you believe you face that this kind of you have this tax situation, I see a lot of mistakes based around this concept. Okay.
How are we?
Last one, opportunity. We all love opportunity to reduce the tax consequences, right? So back in the days, I bought a house and I rented it for years. And market is reviving, I decide to sell it. Oops, I have a lot of gain, right? So what do we do? Any opportunities around that? There is a concept called like-kind of exchange. Just like it says, it's a like-kind, meaning the two property in a similar kind, you are just exchanging, right? How does it work? Here I have very small house. When I was super young, I bought this one and then I rented it. You sell it, the proceeds from the buyer, you cannot touch their money. I'm sorry. If you want to get a tax benefit, you don't want to touch their money. That directly goes to qualified intermediary. Who is that? That is accountant, lawyers, investment advisor, financial advisor. You cannot work with them. At least gotta be somebody who hasn't had a business relation with you for the last 2 years. So it's a completely independent party, simply speaking. So that person gets some money from the buyer of my cute little house, and they deposit into an escrow account. And within 45 days from the days from the sale of the property, you have to identify what's going to be my new asset, replacement asset. And then within 180 days, we have to close the entire thing. One thing here though, 180 days, by nature, 6 months, we have a 6 months. And then especially when you miss that 180 days, you feel like, well, it's a business day. We're like 6 months, we have a couple more days because we have a couple of more months with one more day, right? No, 180 days. So make sure that it's not 6 months, but 180 days. And all these real estate transactions are done through the settlement sheet, no room for negotiation. This is not the gray area. This is a black or white, where you meet the 180 days rule or you don't meet it. And so what happened here is that, okay, I get it. We have to have a qualified intermediary, we have to have a like kind of a property, 45 days, 100 days, I get it. So what? What this one does for us, the tax savings that we can get out of here is that whatever is the gain that you're supposed to pay tax in the year that you disposed of my cute house, you don't have to pay tax on that. Instead, that amount of the gain reduces your basis of the new property, this extravagant property over here. So let's say that you bought this property for $400,000 this year, right? And your gain from the selling the old property was $50. You start with the $350. And when you sell this replacement property, you start with a lower basis. So whatever you sell, your gain is going to catch up. So in the tax world, there are not many you're super tax-free thing, right? Unless you have a primary resident that meets the gain exclusion or any of that nature. So technically speaking, the savings that we get out of this concept is deferring. You don't pay tax this year, but down the road when I dispose my second property. Do you have any questions? Okay.
Can you only do this once? Or can you continue to do this to multiple properties?
As long as you meet, you can continuously execute this transaction. Okay. Now, excited. Let's save money here. Most commonly used, commonly missed tax incentives here. Okay, we talked a lot about real estate today, right? Any way we can increase the deduction out of the rental activities. Let's see what we have here. Cost seg study. Example here, 39 property, business commercial property, real estate rental. And what the cost segregation does is basically ripping apart the main property. So for example here, we have a word, landscape, HVAC, flooring, door. What do you do with that? If it is a 39-year property, basically divide by, whatever is the cost of the basis, divide by 39 years, that's the average yearly depreciation that reduces your rental income, right? Are we all on the same page? But by separating this asset out of the building category, each of those gets a separate life. For example, unfortunately, the word is a 39 because it's considered as a structural component of the building. Landscape, 15 years. So if you were to allocate a certain amount to the 15 year, you have a more deduction, right? Because rather than dividing by 39, basically you divide the cost allocable to this property by 15. So more deduction. HVAC, this is another area that gets hit hard, but commonly considered as a 39-year property. And flooring, unless it is something you cannot rip it off, like a carpet and that kind of nature, it's 39, but let's assume that it's a vinyl, then it's a 5-year property. More deduction. What about the door? If you replace all the doors and the frame of the door in the building, then it's a 39, but otherwise it can be treated as a 5 or 7, depending on the situation. So, what we learned here, guess what? Even toilet gets its own life. If you replace the toilet with a toilet bed, it's a 39-year property, but if you only replace the toilet, it's a 5. Can you believe this? They have really nothing to do, right? So what you do here is that basically increasing the depreciation to reduce your rental income. What is the eligible property then? Do you remember 1986 that I mentioned to you earlier where all the tax shelter haven't fell apart? They took away that great tax savings opportunity, but they gave this to us. So any property constructed or being serviced after 1986, any expansion, renovation, new construction, the leasehold improvement, you name it, is eligible. And how does it work? So let's say that, who do we make a measurement? Sherry, about a commercial building. It's got a 10 floor, wow. And unfortunately, she bought it 10 years ago. And she just learned about it today, right? It's like, ouch, I missed that opportunity. And it is not. As long as you have, so if there's a building that you purchased before 1986, this is not available. But because of the fact that it's after 1986, you can go back and do the accounting method change. What does that do to you is that you calculate everything under the normal depreciation method, meaning that total cost of the building divided by 39, and you add up, right? We call accumulated depreciation. And the second set of calculation is that you do the same calculation by the asset category that we discussed. So you break the building apart, and then gives its own life by the life, and calculate the depreciation by life of that particular asset. Of course, it's going to be more than the first scenario where we get a deduction over 39 years, right? whatever is the difference is gonna be catch-up adjustment in the year that you make accounting method change. So basically, as a part of the return, you add the Form 3115 and fill out the form, and there your savings is. We talked about real estate professional, right? If they're in that business, this is particularly especially beneficial to them because there is no limit. They can reduce their earned income by all the rental losses that they incur being as a real estate professional, right? So this could save a lot of tax dollars. Any questions so far? Okay. Have you heard about Section 199, 9% deduction? If you are, so, before we go to the deduction, what is the qualifying activity for Section 199 deduction? If you're in the production, manufacturing, construction, or engineering or architectural services and film production, then it is qualified activities. And I'll give you one example. Phillies, right? We own our Phillies. Do you think they are qualified for 199? Yes or no? Any volunteer? No? Okay, I say yes, because I did it. So, Philly has two operations under one umbrella of Philly. Simplifying the situation. One is you have a game, right? Sell the ticket and run the game and participate in the league and so on. Another set of activities dealing with the players, commission evaluation and hiring players and all that kind of nature. The first activity is qualified for 199. Could you believe that? Because they consider this as a film production activity because people come and watch. That's what it is. So if you believe we have qualified activities, basically, when you prepare the return, you start with the revenue, all the deduction, and you have taxable income, right? Here, the methodology we use is divide the entire debt activity, the taxable income activity, generating taxable income activity into two different buckets, qualifying, non-qualifying. And every single thing on the line item, you get allocated into two different activities here. For example, we have a cost of goods sold, direct expense, direct SG&A or other G&A, and you arrive in the taxable income, right? So we have three set of book here. Taxable income, the main combined activity, one being non-qualified and the other being qualified. And you compare the bottom line, meaning taxable income and the qualified production activity income, and whatever is the lower, you have a 9%. And if it is if it is lower than 50% of your eligible wages, meaning that any wage related to the qualifying activity, then you have 9% as your deduction. But unfortunately, if you don't have a taxable income, here I say 9% of the lesser of the taxable income or the qualifying production activities, so then no deduction. Last one, my favorite one. How can I go to a seminar and not talk about R&D credit? It's my baby, by the way. So R&D credit, whenever I bring up, especially like seminars or even my client R&D credit, they always say like, forget it. Oh, I heard that you claim the R&D credit, you're screwed. You get audited like instantly. I know where it's coming from because it used to be a tier 1 issue where if you claim the R&D credit, IRS audits that return, they have to mandatory review that credit. So, okay, I get it. Another thing that I hear is that, I have a small shop. I don't even think that we are eligible. Or, my business, I'm not inventing anything brand new. Why would I even care? Those are the things that I hear whenever I introduce the concept of R&D credit. Then, do you think it is the truth? Let's find out. This is the true statistical sampling result from the IRS for 2010 return. And actually, indeed, it is on the IRS website. Only thing I want you to pay attention to this is the first column over here. Look at the industry category. Finance and insurance, R&D credit. Can you link those two? Probably not, right? We have a holding company, real estate, rental and leasing, R&D credit. Are you sure? Or we have a social assistance services, art and entertainment. What does this table tell us is anybody can claim the R&D credit. Maybe we don't know about it, right? Then how do you claim the credit? What's a qualified research activity then? As long as you meet this 4-part test, in the beginning, you come up with a permitted purpose. Basically, you want to do something, improve the process or product or technique, whatever. And from the beginning, you don't know how you're going to get there. You don't know the design, you don't know the methodology to get there. So you have to have 2 alternatives at least, meaning that, especially the people who are involved in this activity, they are like science brains, right? So they know from the beginning, I know what to do from the beginning. That's good for business purposes, for R&D credits, and that's why instantly no credit. So here we have to evaluate the method or techniques or methodology or any of the nature, and we gotta have at least 2, because we gotta evaluate. And then this activity should fundamentally rely on hard sciences such as physics, computer science, engineering, biological science, and then nature. So, going back to the table, now, are we sure we cannot because what you do is not R&D? In other words, no matter what you do, any industry, anybody, any entity can claim this R&D credit. You know why? Because it is all about the 4-part test that I just went over with you. Not because of a certain industry you are in, not because you make a ton of money, not because you are inventing something brand new, but because of the fact that you meet the 4-part test, you have an R&D credit here. I hope you now, with this topic, you are a little more open-minded to R&D credit. And actually, whenever I talk about R&D credit, people give me a hard time. Well, by the way, do you know it's expired? I do. It was expired as of 12/30/2013. Why I am wasting your time? How many people here wasting time here, right? The thing is, it was introduced in 1981. It got expired for 15 times. 15 times. And just got expired, right, as of 12/31/2013, and awaiting for 16th time renewal. Back in the days, I used to work at KPMG, and then there is a consulting group that studied all this credit, including the R&D credit. And one of the senior managers at the time asked me, Myunghee, I think we can work together. Do you want to join our group? And at the time, only thing they did was the R&D credit. Associate, first year associate, know nothing about tax, and said, well, Pete, I don't think so. Everybody looks at me. It was like 10 people, and that is the group that everybody wanted to go, and young associate in front of my face saying that, no, I don't think so. So he asked me, why? Well, credit gets expired all the time. It doesn't look like it's going to be permanent credit, and I need my paycheck. That's what I told him. But I joined though, anyway. That's why I'm still talking about R&D credit. But this got a future because this is the credit that brings all the money overseas into America. And this is the pride that US has. We want to be top notch. We want to be top. We want to be the leader of the technology and science. Because they believe that's the market that carries all the entire world. And before I close this one, here we go. We don't know what's going on, but we'll be there. And this is also one of the incentives that gets both bipartisan support. And since 1981, every single administration supported this one. By the way, Delaware, ahead of the game. We made this credit permanent last year. Isn't it amazing? My present, I'm gonna tell you one more story. I have a 5-year, very cute daughter, right? And dinner time, it was like around the Christmas last year, we talk about, we have a term so that we kind of tell what happened during the day and whatever. And I was talking about this R&D credit, and at the time, there was a question about extenders gets extended or not, meaning that all those expired credit or tax deductions gets extended or not. And I said, darn, that R&D credit, I want to get that extended, I don't know what they're doing, and I was just, going on and on and on and on. My daughter said, Mommy, I have a suggestion for you. So what is it, Vienna? And she tells me, write a letter to Santa. Thank you for your attention. Thanks again for joining my session today. And if you have any questions, I'll be around.
Great.